Hello AP Macro students, I'm Mr. Sanabria, and today we're going to be kind of concluding our discussion on GDP, which we started last time, by taking a closer look at the things that do not count towards GDP. Some of the things on this list are a bit of a review of things that we kind of touched on last time as we looked at what did count, and some of these things may be a surprise to you. So as we go through this list, it's actually quite short. I want you to, of course, note the things that don't count, but also understand the reasons why they don't count. And that will be apparent as we go through the list. The list is not very long. There's only 2 slides here. And after we're done going through recapping and understanding the things that don't count, I'm going to have you do a little bit of an exercise, and then we'll go over the exercise together. Okay, so today's a little different than usual, a little more interactive perhaps. And let's go ahead and get started. We should have a good time with this. So the first thing that we want to talk about that does not count towards GDP is used goods and slash secondhand goods. Okay, so you have used goods, you have secondhand goods. You should already understand this one, right? This one's actually a bit of a review because one of the things that's part of our definition for GDP in the first place is the market value of all new goods and services produced within a country in a year, right? All final goods and services produced that year. Okay? So what that's not going to include is anything that is produced last year, the year before, 20 years ago. All of those things already counted towards GDP. Right? If we think about it for a second, we'll understand that if a vehicle was made last year, then it counted towards last year's GDP. Well, what if no one bought it? We have a solution for that, right? Because the unsold inventories count towards gross private investment. So the bottom line is this. If I purchased something that was made last year, we would be counting it twice. We'd count it for last year as part of unsold inventories, and then we're going to count it again this year, and that wouldn't make any sense. We'd be overcounting GDP, and it would become a useless measure of economic growth. Similar reasoning is behind not counting second-hand goods. If I go to the Goodwill and I buy a nice, used jacket, even if that jacket was made this year, it was already purchased. And so it already counted towards GDP. And so we don't want to double count. So the reason that we don't count used goods or second-hand goods is because there should not be any double counting. Okay? We only want to count the value of things that are produced one time. And if you think of it that way, it's not really too bad. So that's used goods and second-hand goods. The next thing is gifts and transfer payments. Now remember, what we're doing is we are counting GDP using what's called the expenditure approach, right? And what we're doing is we're measuring everybody's spending. So you might be tempted to think of someone giving a gift, like a financial gift to someone, as spending, but it's not. All that happened there is money moved around. So let's say you have a wealthy uncle who gives you a $10,000 check for graduating high school. Good for you. That's awesome. Wish I had that uncle. But that $10,000, that's not spending. That doesn't count as consumption spending or anything like that. Okay, that's just money moving around in the economy. What's really going on there is that there wasn't any economic activity that occurred. Now you're going to take that $10,000 and you're probably going to participate in some consumption spending with it. And whenever you spend that $10,000, any dollar of it you spend on goods and services produced within the country in the year, well, that's going to count towards consumption spending on GDP. But the gift itself or the transfer doesn't count. So let's hit on transfers real quick. Remember, transfer payments are those government payments that are given out usually as part of some sort of social program, like VA benefits or Social Security or Medicare, Medicaid, housing assistance. Those sorts of things, they don't count as government spending, and we touched on that last time. So that's a bit of a review. Next thing that's not going to count towards GDP are any of these financial transactions, because once again, nothing's being produced, and it just amounts to money moving around the economy. So if I purchase a bunch of stocks, you might think, oh, I spent money buying stocks. But a stock isn't a product. It's not a good or service. It's a financial asset. Nothing was actually done. Money moved around in the economy. My money went to someone else, and I got a little bit of the ownership in that company. Okay, and the same thing is true of equities of any sort, securities of any sort, or bonds, any other financial assets. Okay, so if you see anything about a financial investment in stocks, bonds, equities, securities, that doesn't count towards GDP. Then we get to the fun stuff. There's some things that don't count towards GDP, even though we would count them. It's just we don't know about it. And so how are we going to count it? And that's things like this unreported business activity, such as the tips you might get. How many of you out there have a job as a waiter or waitress, or perhaps babysitting, or some other thing where you get paid in cash? And my question to you would be, how much of that cash actually gets reported to the IRS? Now, I'm not trying to make you feel bad if you don't report all of that, even though you should. The point is here that it would be counted towards GDP if you did. Okay? It would count. Because if you go out and say babysit for the neighbors and get paid $100, well, then that was $100 paid for a service. That service was added to what was the aggregate production of the country. One of the things produced was your services as a babysitter. But no one knows about it. And so if we don't know about it, we simply can't count it towards GDP. So this would actually be one of those things that doesn't get captured by GDP. And there's a lot of stuff that happens. There's a lot of these transactions which happen in cash and never get reported and can never be counted towards GDP. Okay? Now we're going to continue this list with something similar but slightly different. This is going to be our black market activity. Now, technically, the last thing we talked about is black market activity because it didn't happen within the legal framework of the economy. However, when we think about black market activity, we're normally talking about those activities which are actually illegal, but are economic in nature. So you're selling things that it's illegal to sell, usually having to do with illegal drugs or firearms, prostitution, those sorts of things that we understand as illegal black market activities. Now, here's the interesting thing about black market activities, that illegal black market activity. We may actually know exactly how much money changed hands. We may be able to measure the value of that activity. We choose not to count illegal activity as GDP. So say we, bust up some sort of a crime ring and we have access to their books, and trust me, they probably keep very good books, and we could know exactly how much economic activity was generated by this organization. We're not going to turn around and take that and add it to GDP because it's illegal activity. Okay? So with our last example, and I'll go back to it, the unreported business activities that are otherwise legal, well, we simply don't know about them, so we're not counting them towards GDP. These sorts of black market activities are illegal, and we choose not to add them to GDP. The next thing here is financial transactions between banks and businesses. And this is very similar to you or I purchasing stocks or bonds. This is businesses, moving money around. Again, did they produce anything? No. They moved money around in the economy, and so they're not going to count. We're almost done with our list here already. This is a nice short one. This is an important one here, this intermediate goods. Intermediate goods. Let me spend a second here. There are a lot of things that are created, that are produced, manufactured, sold, but they're not the finished product. They're these things that you buy in order to make something else, right? They are capital goods, but they're a specific kind. They're intermediate goods. So what I like to use an example of is if I am a restaurant and I purchase a bunch of loaves of bread, but I don't sell loaves of bread, I sell sandwiches, well, the bread that I just bought was an intermediate good. I bought that bread, but I'm really going to sell it in the form of a sandwich. So when I buy that bread, that does not count towards GDP. Well, why not? No, because I'm going to count the value of the bread when I buy it and then again when I sell it as part of the sandwich. No, that's no good. We have to understand that when you purchase a sandwich, you're buying the bread, the lettuce, the tomato, the meat, the cheese, the condiments, the service of whoever put it together, the service of the person that you talked to at the counter who typed in the numbers and put the order in, and everything else along the way, the shipping of those goods, everything. In fact, if you really think about this for a second, the fact that you can go to the store and buy a sandwich for under $5 should blow your mind. You're purchasing a lot for only $5. And that $5 captures the price of all of that went into making that sandwich. Does that make sense? I hope it does. In a simple statement, the reason we don't count intermediate goods is because we can't double count things. Okay? The same thing applies to every kind of thing that you can purchase. Look at vehicles. When you purchase a vehicle, you get a lot of different kinds of things. You get a stereo in there. You get the speakers that go with it. You have the tires. You have the windshield and the windshield wipers. You have all of the upholstery and the seats. All sorts of different things that some of them are made by different companies, and they all come together and they're sold as one big vehicle. Well, those things individually, they never get counted towards GDP until you buy that car or truck. And when you do buy that vehicle, it captures the value of all of that stuff. And so that's what's meant by no double counting, and that's why intermediate goods don't count towards GDP. And then finally, there's this idea of non-market activities like volunteer and family work. Okay, if I go ahead and I put a new tile floor into one of the rooms of my house, well, even though it added value to my house, and even though if I had paid someone to do it, I would have paid quite a bit, the fact that I did it myself, it didn't add anything to GDP. Now, of course, when I went to Home Depot and buy the tile and the grout and the other things I need to do it, that's consumption spending. But me actually putting that floor in, that doesn't count. It's just not captured by GDP. And there's a lot of stuff, obviously, that we do around the house that does have value, but that value isn't market activity. Now, this can maybe get a little weird if you start thinking about the things that people do professionally. So what if I was a plumber? Well, if I go to your house and you pay me to fix your toilet, that counted towards GDP. But if my toilet backs up and I fix it, well, that didn't count towards GDP, even though I did the same thing. I added the same actual service to what happened in the economy that year. It just isn't market activity. And hopefully that doesn't confuse you at all. Now, that is our list. Okay, quite short for today. But we're not done yet. Okay, I want you to use what we learned last time when we initially defined GDP and we started discussing the way we added up, which is SIG-X, consumption spending, plus investment spending, plus government spending, plus net exports, right? And we talked about what each of those include. And then today we went back through and we reviewed that a little bit, and we talked about specific things that don't count towards GDP. And now I want to apply this a little bit. So I want you to spend some time going through the sheet that you can download that I created called Questioning GDP. And I'd like you to go ahead and do that now. I'd like you to try to do it without your notes. And then we're going to go through that sheet together and we're going to see how you did. Okay, so go ahead and work on that right now. Alright, so here we are. We're back. I've actually changed clothes. It's the next day for me. Hopefully it's only a few minutes later for you. And you finished the Questioning GDP sheet here. So now let's go through it together and let's see how you did, and let's make sure we understand exactly what happened with each of these examples, and we understand basically everything you would want to understand about GDP accounting. Okay, and that's what this topic's called, GDP accounting, calculating GDP. So section 1 here is all about what's counted in GDP, and it says to indicate whether each of the following is part of GDP using the expenditure approach, right? So the expenditure approach is measuring spending of consumers, businesses, investment, government, and net exports, right? Let's not confuse this. Let's be really careful here to not confuse it with the income approach, which would be measuring everyone's income, right? Slightly different, but you have to keep in mind we're thinking about the money as it was spent, not the money as it was earned. And so we'll keep that in mind as well as we go through this. So let's go ahead and just get through this. Number one says a farmer purchases a new pickup truck to use on his land. Okay, so if a farmer purchases a pickup truck to use on their land, that is counted in GDP. And this would actually be, I'm going to do a little bonus as we go through this. If it is counted, I'm going to tell you what component of SIGEX. And this would be I. This is investment. Okay, so if you're a farmer and you're using a pickup truck on the farm, well then what you actually have done is invested in this new piece of machinery that can be used on the farm. Okay, so it's actually not consumption spending if that's what you were thinking. So this is counted in GDP as gross private investment. Number two, and I'll highlight these so we can stay together here. Number two, a plumber buys a bundle of 1-year-old tools to use on job sites. Okay, so a bundle of 1-year-old tools, used tools to use on the job site. You might be tempted to think, oh, well, this is an investment, right? It's something that a business owner, or at least a person who does a business, uses to do business, and so that's investment, but it's not, because these are not only used tools, but they're also 1-year-old. Okay, so this meets both of those criteria of things that are secondhand goods. They've already been sold once, so they got counted towards GDP, but also even if they were brand new, but a year old, they wouldn't count towards this year's GDP because they would have been counted as unsold inventories last year. Okay, so this number two does not count. Number three, an investor purchases a U.S. bond for $100. Okay, so this is not going to count towards GDP because this is a financial product. Remember, all that really happened here is money moved around in the economy. So I really just changed money from being something really spendable to something that I can't spend. And so, no, an investor buying a bond does not count towards GDP. Well, what if a mechanic spends 3 hours changing the transmission on his car? Well, normally when that mechanic changes the transmission and spends 3 hours, they might get paid a couple $100 or something. But this is his own car, and he's not going to pay himself because then he'd have to tax himself, and that wouldn't make any sense. So no, this falls into that category of non-market activity, right? He understands how to do this procedure. He goes ahead and does it. He doesn't charge any money. No money changes hand. It was an economic activity. And even though there was value added to that vehicle, it doesn't count towards U.S. GDP. Number 5, the government spends $1 billion on Social Security checks. Social Security is classified as what? A transfer payment. And so this does not count towards GDP. Transfer payments do not count towards GDP. You might be tempted to count it as government spending, right? But it's not. Number 6, Toyota increases its inventories. Okay, so Toyota increases inventories. Well, that's a change in unsold inventories, right? And yes, that does count towards GDP, and it counts as gross private investment. Number 7, the U.S. Army buys 5 new Apache helicopters. This is an example of government spending, and so this does count towards GDP. The U.S. Department of Defense spending on defense, that is government spending. Number 8, a student spends $25 on a haircut. Once again, this is part of GDP, and where this counts is consumption spending. That's kind of your vanilla textbook. That's consumption spending. You go out and you buy a haircut, which is a service from a business. There you go. Number 9, an investor receives $700 from selling her Nike stock. Okay. Once again, you didn't actually do anything that was productive. It was just money changing hands. And so this is that kind of financial transaction only, doesn't count towards GDP. And finally, last question for this section, Apple Computer exports $3 million worth of iPhones to China. So if Apple Computer exports or sells $3 million worth of iPhones to China, that actually does count towards GDP using the expenditure approach, because it will affect net exports. Because net exports is exports minus imports. Okay, so this is money that goes kind of to the plus column, and then anything that we imported, or the value of that, would be minus column, and we'll see how it shakes out. Remember, I said that net exports since World War II has always ended up being a negative number for us, and that's what the trade deficit is. Okay. Now, section 2. This one is actually asking you to do what I just did with that one. It's saying which component of SIGEX, consumption spending, investment, government spending, or net exports, right? Which of these components of SIGEX do each of the following items count towards? So each of these actually is counted in GDP, and what I really need you to do is tell me in what component. So $7 spent on a new comic book. If you said consumption spending, you got it. Okay. Number 2, a family purchases a new home. Okay, this does count, of course, and you might be thinking, well, a new home, well, that's a house, right? Household spending, but it's not. This is not household spending, and don't fall into this kind of pitfall, because a family purchasing a new home is actually gross private investment. Okay, remember, we treat purchasing a home as an investment because you have to take out a lot of debt to do it in almost every case. And it appreciates in value, meaning whenever you sell it, it's probably worth, in most cases, more than when you bought it. That is a lot more like an investment than any kind of consumption spending, where you typically don't take out debt unless it's something very big, like some furniture or automobiles. But in those cases, they most likely will not appreciate. So it's consumption spending. You consume that thing. Whereas with a home, you invest in that thing and it grows in value. Okay, so number 2, gross private investment. Number 3, the government increases infrastructure investment by $1 billion. Well, it's kind of hard for me to get tricky on this one. That is government spending. So hopefully you put G for government spending there. Number 4, at the end of the year, a shoe factory has $10,000 worth of unsold shoes. Okay, so we've got unsold shoes, which is unsold inventories. Hopefully now we're pretty clear on the idea of unsold inventories count towards gross private investment. Number 5, Chevy buys 4 new machines for the car factory. Okay, so we've got Chevy, one of the automakers, and they buy 4 new machines that are going to help in the car factory. This is going to be investment. Okay, this company invested in this product that's going to help them make more money. Number 6, a college student spends $400 a month on rent. Okay, so a college student spending $400 a month on rent, that is consumption spending. Okay, that is part of the spending that you're doing as a consumer, is where you live. Number 7, the city of Austin builds a new school. Okay, so the city of Austin builds a new school. Well, what does the city of Austin represent? It's a government, right? This is a municipal government. But remember, government spending is occurring at all levels of the government. And so what we have here is government spending. And finally, number 8, you eat lunch at the local taco stand. Something I enjoy doing. Well, guess what? That is your standard consumption spending. Okay? So there you have it. That is a little practice in assigning different kinds of expenditure to different components of SIGEX. So hopefully you did well there. And finally, let's do section 3, which was a couple of short answers. And the first question, why don't we count intermediate goods as part of GDP? Well, the simplest answer there is because we don't want to double count. No double counting. why would you be double counting if you counted intermediate goods? Well, I guess the first thing is to understand what exactly an intermediate good is, and that's a good that is part of the process of making something else. So if I am the factory that makes iPads, and I buy my iPad screens from some other factory, well, I'm not going to count the purchase of iPad screens as GDP. I'm going to just count the total cost of the iPad as it's sold, finally, because that cost captures the price of the iPad screen, as well as every other component of the iPad. Now, I don't know if that's exactly how iPads are made, but you get the point that I'm trying to make, I hope. And finally, number 2, when we import goods from other countries, how does that affect GDP? And this is me wanting you to really think through the idea of net exports and what's actually happening with net exports, okay? It's going to be your imports minus exports, right? So how much money did we make selling stuff to other countries minus how much money we spent buying stuff from other countries? It's a difference between the two. And what ends up happening is one of those numbers is going to be bigger than the other, right? And the number that's always bigger is how much we purchase from other countries. And so when we separate or subtract, the amount of money that we spent importing goods from how much we made exporting goods, we end up with a deficit. We end up with a negative number because of the trade deficit and the fact that we import more than we export. So when we import goods from other countries, the effect that that has on GDP is to decrease GDP, okay? Because that is money that is being subtracted from exports. That is making the net exports decrease. Okay? So hopefully you understood every part of this little practice sheet, and that's all we've got for today. Happy studying.